Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, go through it. If you want to follow me at @Finance, and if you want to join our community, findingvalue.com, where I dive deeper into all this stuff, looking for investments in individual companies and sectors. I break down how I'm doing it, the strategies I'm deploying, portfolio allocation. I do everything. And if you want to see what I'm doing and you're interested and you are looking at financial stuff and continually watching YouTube channel, or YouTube content on finance, I think you'd fit right in on the community. So Black Friday, that coupon code is still active if you'd like to use it, and you can join the community and talk stocks all day with all of us. So Bitcoin for freedom. It says zero point 0.1 BTC will make you a millionaire in today's dollars. If you think that's crazy, you don't understand it. That's what everyone says about crypto. And I'm seeing this everywhere. So let me break this down. Every single comment about Bitcoin or Ethereum or some sort of crypto, all they talk about is getting rich. So my question then is, what use is Bitcoin to me? What use is Bitcoin to anyone? Why should someone buy it? If there's no reason to be in it, if there's no use case, I don't understand why people want to go in. All they're talking about is getting rich. That's called a Ponzi scheme. And you need more and more adopters to adopt it in order for it to work. Now, some people will say, well, it's gone through multiple cycles. Gone through multiple cycles. And I'll say it hasn't. It's gone through multiple cycles in a bull market. It's never seen a bear market in technology. So I know people think they're going to get rich off of it. I think that a lot of people think that it's going to happen very quickly. And maybe some people do. Very well could be the case. All I'm going to say is we've been in a bull market since 2011 for technology, 2010, 2011. We have not had a massive pullback in technology yet. If we go through an extensive bear market, I don't know how BTC will fare. That's all I will say. And because of the lack of history and because of the lack of use, I think it carries a lot of risk because of those things. That's what I'll say there. So here's Gary Savage. He says, cold hard truth. You can achieve a middle class lifestyle if you make mostly sound decisions and earn a living as an employee. If you want more out of life than just being average, then you have to take a different path than the average person. The key to achieving an upper middle class or upper class lifestyle is to own assets. Instead of working all week and then blowing your salary on depreciating crap, you need to work all week, save your money, and then buy appreciating assets. Start a business on the side, buy Bitcoin. Disclaimer, Bitcoin is starting to show signs of bubble behavior. I would agree. You will need to control greed sometime in the next 6 months to a year and sell so you don't get caught in the crash. A very simple way to acquire assets and build wealth would be to turn your salary into physical gold and silver. Both are in major bull markets and still have 2 to 4 years to go. When you start to see the average clueless lay person bragging about how much money he's making on his gold and silver, like people are starting to do right now with crypto, then it will be time to sell. Owning appreciating assets is the difference between a middle class lifestyle where one serious mishap could ruin you and the mostly worry-free lifestyle in the upper middle class and upper class. I've shown you a very simple path. Now it's up to you if you want to escape mediocrity. That's exactly what I show on the website, is how to accumulate assets at very good times and then have basically the staying power, the emotional fortitude to not get sucked into bubbles and to show you where good entry points and bad entry points are. That's the whole thing about investing. If you were to break it down, guys, it's this simple. Buy cheap crap sell expensive crap. Don't don't get sucked into things just because you think they're going to continue to go up. Buy stuff that's down, and it may be down for a decade. But if you understand the cycle is going to come back into favor. There are certain traits to look for to determine tops and bottoms. And I'm not saying that we're at the absolute top of the S&P and the Nasdaq. It can continue higher. But it all comes down to risk reward, asymmetry, and getting good entry points. That's where all the money's made. And you have to adopt a style for the most part if you want to make a lot of money that is different than everyone else because everyone else doesn't have a lot of money. So if they don't have a lot of money and a lot of people don't make a lot of money in the markets, you have to adopt a different strategy than them. Why? Because most people don't get rich off the stock market in short periods of time. You have to adopt patience over impatience. You have to adopt low risk opportunities that you may have to wait for it to go versus high risk, but it's moving right now. That's the difference. And then once you start to develop this portfolio of buying things and you ladder, I'll call it a laddered approach. So you got money that you accumulate, you buy an asset a year or two ago, and then all of a sudden it starts ripping, right? You're up 100%, 200%, 300%, 400%, 1,000%. And you're buying different assets that are down while these other ones that you bought a while back start to rip. And then you just accumulate what's cheap. And there's strategies to do that. Then you just have this cycle where your portfolio, some of it's ripping up and other stuff is at good entry points. And then you just continue to accumulate. Here's Ira Joseph. He says, European gas storage is I think that's billion cubic meters below the 5-year average. If you strip out 2021, when Russia actively stopped storing ahead of its invasion, storage is 3.6 billion cubic meters below. November draws hit an 8-year high due to cold weather and slow responding LNG. It also is not much wind because they're not producing as much solar and wind, and they're using natural gas to cover that. And that's where the weather factor comes into play here. But demand rose by 3.3 billion cubic meters year over year. And it's a combination of cold weather and windless, cloudy weather too. Global rare earth metals production 2023. This is part of our collaboration. The rare earth element production by countries. So 68% by China, 12% by US, Myanmar 11%, and then really not much anywhere else. 5% Australia. Job openings are declining rapidly. Now, here's another thing to bring up. I see this, and a lot of people, oh, we're going to get a recession, jobs are declining. Here's a question. How much does AI fit into this? If artificial intelligence is successful, shouldn't we see job openings decline? Shouldn't we see unemployment go up? Is it possible that we have unemployment go up, job openings go down? It looks completely like a recession, but AI is actually replacing these people. Like, what does that transition look like? I don't hear anyone really talk about it. I hear people talk about people getting some sort of basic income from the government because of artificial intelligence taking all these jobs. But like, what type of signals does that send to the market? Does that send to the market that we're going into a recession and everyone on Twitter is going to be like, oh, unemployment's going up, job openings are declining rapidly, we're going to go into the greatest recession ever? But what if that's coming from AI and the companies are actually becoming more efficient with less people and turning things even faster? How would that all look out in the future? It would look like a recession, but we're actually getting even better and faster. So the company should have even better earnings at some point. Coming on with Elon, America is headed for de facto bankruptcy very fast. So this is the U.S. national debt 150-year view. You can see the big move up in the 20s, 30s, 40s, and then the debt shrank. This was an increasing interest rate environment from the 40s, early 40s, all the way to 1980. Increasing interest rate environment. Now, I don't know what this is. I mean, look at the projection here. This is just go straight up. Now, that could be conservative. Imagine if interest rates ballooned this thing to the upside. As debt increases, I think that interest rates will go up too. Because people are not gonna they're not gonna want to hold the debt. They're gonna be like, look, you guys have a problem. You're just gonna print your money. I don't want to hold your debt. Give me like 20% interest rates, and maybe I'll buy it. But then if this debt's coming into the system and they're creating all this money from the interest payments, I mean, there's gonna be a lot of money in the system. It's gonna be very inflationary. So what does well under inflationary periods like this? Gold, silver, platinum, oil. Oil is one of the most sensitive to inflation. And what I'm playing is this going up like it is, and oil is going to have to go up with it. And if there's any sort of problem in oil supply, it's going to move because what this is demand for oil. The correlation between M2 money supply times velocity is GDP. GDP to oil consumption has an R squared value of 99.6. What that means is that GDP is oil consumption with a 99.6% confidence level. So if this debt goes up like this, I mean, that's your oil demand for the most part. HFI research, OPEC supplies are peaking a lot sooner than you think. It says peak supplies are happening a lot faster than you think. And by being overly fixated on 2025 oil market balances, people are not looking at the oil market clearly, which is the big picture. They don't look at this debt coming and say, oh, well, can we increase oil supply and GDP? GDP, so think of it this way, guys. You're increasing your debt rapidly, which means you need to increase your income rapidly. Your income is your GDP. But GDP, in order to increase GDP, which is making real crap in the world, you need to increase your oil consumption. Because oil is the driver. It transports the goods. The goods are made out of oil, and it provides energy to do it. So I mean that's the whole thing here. And people are looking at this at 2025. There's supposed to be a surplus in 2025 with some projects coming online around the world. And we'll get into that a little bit with Petrobras. So anyone think that it's time for money to rotate into semiconductors, considering that we're in the middle of a bull market and they've got not a top formation, shoulder, head, shoulder. I don't know if that's a top formation. He says potentially up. We'll see. Save when you can, not when you have to. So that's just basically save when you can so you can buffer when you might need to draw on it. That's all it is. So if you don't have if you're not smart enough to save when you can, you're going to get into some tight problems at some point. That's your 3 to 6 months of emergency savings that most people save up. So you save it when you can, stock it away, and if you don't have the income at some point, you've got some sort of buffer. Rock bottom entries. He says the USD now ready to roll over, rocket fuel for commodities. And I don't know if that's the case yet. I'd really like to see some big moves lower. I really would like to see some big candlesticks. Then I would be in that camp. But I'm still waiting, still watching. And my conservativeness comes from the long end of the curve. Do people realize that the IEA has Brazil adding 800,000 barrel per day of new capacity in 2025, while Petrobras is expecting production growth in total of 400,000 barrels per day from now to 2029? There's all these disconnects in the numbers, guys. This IEA doesn't know how to do an oil field decline analysis or something. So this is total production here, million barrels per day for Petrobras. There's the move up. That's that's 300, zero point 0.3 or zero point 0.4. So 400,000 barrels per day. That's what he's getting it from 2029. And this here is the cumulative select new offshore supply. This is Guyana, Brazil, US, Norway, other, and non-OPEC. And this is what I think they are projecting as this big move. Now, here's the thing. I don't know if we're going to get this because offshore is looking awfully weak right now. We're going to see. This is going to get tight here, guys. We're going to get tight over the next few years. Porter Stansberry, the last time U.S. stocks were this overvalued versus the rest of the world was, well, never. 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 So, what does that mean? What does this mean? It means that this is the greatest opportunity to work your way into other emerging market equities. This one's Europe. Now, I don't know if I'd go into Europe. I think Europe's pretty much dead, and that's probably partially why it's here. But I do think other spots in the world that are commodities rich are going to do insanely well. And everyone's all piled over in US equities right now. That's where everyone is. And just because it goes up, people are going to be like, oh, I'm making a bunch of money. It's going to turn. Give it time. We don't know how fast it'll turn either. We don't know if it's going to be like a roundish top or if this thing's going to be like a V top that just rips it back down. And all of a sudden you're back to one standard deviation way down here, some 3 years later. That's not a projection. It's just saying it could do that. Eric Nuttall says the twilight of U.S. shale is upon us this year outside of COVID and the Saudi shale battle of 2016. U.S. shale is growing at its slowest pace in its history. And 2025 is forecasted to be the last year of modest growth. Without U.S. shale, the world would have already been in an energy crisis. And the market has been lulled into a false sense of complacency. The energy market is not ready for what is coming. And look at the growth that we have projected out in the future. A little bit of growth in 2025, and then not much, and then we're screwed. Screwed. What's going to happen out here? I don't know. It's going to get interesting. Remember, this is go forward demand growth. 90% of the growth came from this here in the world. This is what's coming. Do you get what I'm saying here? Do you see what I see? A super powerful loophole in the U.S. tax code. Let's go into this. So it says if you're a high earner, you cannot directly contribute to a Roth IRA, but you can do a mega backdoor Roth to contribute $69,000 this year to your Roth IRA. This is how it works. So you can contribute to a Roth IRA. What you do is you put it into a traditional IRA, and then you convert it into a Roth IRA. You can do that. This here is from a 401k. That's where the mega backdoor comes from. So a Roth IRA is incredibly powerful. You put it in after-tax dollars, but then never pay taxes on it again. The tax benefit is so big that the IRS limits people who earn more than 146,000 single or 230,000 married from directly contributing to one. But there's a loophole that comes in. Most people do not realize their 401k plan has an annual limit of 69,000. That's because the employee contribution side is capped at 23K, and typically your employer does not contribute enough to take full advantage of the 69K limit. Wasted potential for high income earners. Here's what you can do instead. Contribute the leftover amount as an operational after-tax contribution, or optional, if your plan supports it. Immediately convert the funds to your Roth IRA. This legally bypasses both the Roth IRA income limit and lets you contribute up to $69,000 a year. Requirement to do this is an employer 401k plan with this feature. A lot of big companies do have it. They also have Roth 401k plans. If you work for yourself and have side hustle income, you can also set up a solo 401k plan that supports this. You can use this to get most of your side hustle income into a Roth IRA. Things to watch out for. You have money to support it. Deferring funds to retirement is great if you can afford it. Convert funds from after tax to your Roth IRA as soon as possible since you'll owe taxes on any gains otherwise. The question. So just to let you guys know, you want, in my opinion, you want some pre-tax money if you're a high income earner. I don't think this guy's a high income earner, but you have to balance the money coming out of your 401k with the money that you make today. If you are a high income earner based off of this here, you're going to be paying high taxes today. So you want to take advantage of pre-tax amounts if you're in the 30%-ish, upper 20% range of those taxes to reduce your taxable income today. Because in order to get that amount of, we'll say, income in the future, and depending on how you structure your portfolios and where you put your money, you can take money out of a pre-tax that's tax deferred compounding up to, a few $100,000 if you're married and not pay a ton of money. Then you can draw from your Roth IRA on top of it, and then you could have other investments on top of that. So if you're a high earner, you may want to take some of that money pre-tax to drop your taxable income today to drop it on down. You don't want to put it all in a Roth IRA like this guy is saying, because more than likely you're going to be leaving you're going to be leaving low taxed money at a lower tax rate in the future. So what you're doing is you're taking 35% tax rate money today off the table, and then tomorrow or in the future, whatever it is, you're going to be drawing at it up to a certain amount at lower tax rate than what you are today. So what you're doing is you're trading a 35% tax rate money for 10 or 15 or 20% in the future, which you want to do with some of the money, not all of the money. So you want to set up a group where you can draw from different buckets of money in the future from taxable money, because some of it is tax free. If you have dividends that you get from investments, you can go up to like $126,000 and you pay zero taxes on it if you're married. And the way that you do that is 96,000 from dividend income is zero, and then you have I think it's like a $30,000 deduction on top of it. So there's all these things when you look from a tax perspective, you can really maximize if you're a high income earner. Even if you're not a super high income earner, you still want to be looking at diversifying your portfolios and your accounts in order to draw from them in the future at lower tax brackets. Strip Mall guy says better financial decision, buys $1.5 million house, and this guy rents. You can obviously tell here. So $75,000 interest to your bank, $18K to property taxes, $5K for insurance, $15K average to fix random things, $113,000 per year thrown away. You could rent a $1.5 million house and you throw $85,000 a year thrown away, and can actually invest that $380K down payment somewhere else. Well, I think it depends on when you purchase the house. I think it depends on how much money you put down. And I think it depends on interest rates, and it depends on inflation, which is a lot of different things. Now, run this. So what he's doing is he's taking all this money here, and he's taking it today and looking forward. A better analysis to do would be to go 30 years backwards and run the same analysis and see how it turned out. Go backwards in time where you have real valuations. Look to see what happened. Or you know what? Do it when the house prices were up and affordability was crap. So do it like in the late 70s, and then see how those people fared over a 30-year time frame with a fixed rate mortgage, and them refinancing that mortgage lower when interest rates fell. That would be an interesting thing to look at. But obviously, he rents. Brazil economy expands again as consumers continue to spend big. Economy expanded 0.9% quarter over quarter and 4% year over year in the third quarter. Investors worry that the Brazilian economy is overheating. Man, I didn't know Brazil's economy was so strong. If you looked at their stock market, it's not too great. But generally, what comes after a strong economy is a big move in stocks. As weird as this sounds, guys, but stocks do well under a lowering interest rate environment and an economy that might not be as strong. But if you're in the right areas of that economy, they'll do very well. Unpopular opinion, buying a home right now at these elevated prices makes absolutely zero sense with rates this high. Well, you want to buy when nobody wants to buy. So if I bought now and rates went down, I could refinance it. And then you don't have to fight with everybody if rates go down. Because if rates go down, people are going to be bidding for there's going to be bidding wars again. So if I could afford it, I would buy a house now where I have a better selection of a house and there's less bids. So maybe I could get it cheaper and then I'd refinance it out in the future. But I'm also in a different situation than maybe someone else. I can put a big down payment down. I don't have to borrow a ton of money. Some people, they put like 5% down, and I'm like, oh my God, you're going to have to pay mortgage insurance and all this other crap. It's hard to get that money in the beginning. It's very hard to get the big down payment. I understand. It took me a long time to do it too. The Money Cruncher says in 2025, married couples can withdraw $126,700 tax-free, $30 or $30,000 standard deduction, and $96,700 long-term capital gains qualified div at 0% from a brokerage account. Now, that's true, but I think if you've got a bunch of other income, yeah, you still pay a bunch of taxes. Trust me on that. That's an equivalent of $170,000 a year salary. The tax code favors investors, not employees. And this is where I am beefing up my knowledge. It's taxes and where I can get all this income. And you guys know on the website, I'm a big dividend junkie to some degree. U.S. construction spending on data centers accelerates. Oh my goodness, look at how fast that's accelerating. Oh my goodness. ChatGPT launched to the public. Boom. Freddie Mac, housing market is undersupplied by 3.7 million homes, and it's the root cause of decreased housing affordability. 3.7 million homes is what we are undersupplied, is the current projection. Housing shortage. So 2018 was 2.5 million. 2020 was 3.8. 2024 is 3.7. We're not really cutting down on the shortage here. We're not building enough homes. That's why the home builders are ripping it. Does it all make sense? Affordability and home sales does not impact this number. Well, affordability impacts the number that they won't build, but it doesn't make the situation any better. So if we have declining home sales, it still doesn't build more homes. It delays everything. Says Freddie Mac, U.S. housing market is short 3.7 million units, and there it is over time. Peter says, by this time next year, the share of U.S. mortgages with rates in excess of 6% could outnumber those with rates below 3%. A good example of how monetary policy operates with lags. Well, that's not a monetary policy operating with a lag. That's just, well, it's a policy that they put in place, but the policy isn't lagging. It's just the function of how the world works. If the longer you stay up, people are obviously going to buy homes at some point, and more people are going to have to do whatever the mortgage rate is if they take loans, what it will be today. So obviously, people with very low loans are going to either sell their house and get a new loan, or sell their house and just go with no loan at all. But obviously, the percentage of higher rate loans are going to go up. Makes sense. What if commodities were just getting started in 2020, 2022? Yeah, you are thinking about that correctly now. You are thinking about it correctly. This big boom, this move here is this move here, and we're gonna get a big move, big move. It's coming, guys. This is CRB index versus 30-year bonds. Oil sands growth equals natural gas consumption growth. Oil sands consumed 3.8 billion cubic feet per day in 2023. Forecast to consume 4.6 billion cubic feet per day in 2033. Rule of thumb: natural gas use per day of oil production. SAGD 1.3 million cubic feet per day or per barrel of oil. Sorry about that. CSS is 1.7. I think that's more like mining it. Down charts of crude net positioning of non-commercial accounts, managed money, and other reportables. We are way down. We are still way down. This is it coming down, and we are bouncing, and it looks like it might go and head back higher here. We'll see. Maybe a little bit of a trend line break there. So we could start to see this work its way on up. This is over the period here. We were way up there in 2018. Now we are bottoming. So cycle up, cycle down, and then it will probably cycle back up again at some point, which could be very soon. The CHIPS Act will go down as one of the great American legislative successes of the generation. This is U.S. manufacturing construction spending just ripping higher, and a lot of it is from computer, electronic, electrical. We can see other going up too, but we're going to have a huge boom in onshoring manufacturing. Oscar Hoole, it says in 1636, one tulip bulb cost more than Amsterdam mansion, 150 times a craftsman's salary, worth 25,000 in today's money. People sold houses for flowers. Then in February, the market collapsed by 90. Here's how the Dutch lost their minds. And this is Bitcoin, which looks the same as the Tulip Mania, which looks the same as Nvidia for the most part. Interesting. He says it started in the world's richest port, Amsterdam, 1630s. Spice merchants built mansions, needed exotic flowers to show wealth. Then they discovered something strange. A virus infected the tulips, creating streaks of vivid colors, patterns never seen before. Breaking virus made them unique. The wealthy went mad. The numbers were staggering. One Semper Augustus bulb, 150 florins, equal to 10 skilled workers' annual salary, more valuable than gold. But it got even crazier. People stopped growing them, just traded bulbs hand to hand, never planted, never bloomed. Pure speculation. Pure speculation. Does that sound? The fever spread. Merchants traded mansions for 10 bulbs. Craftsmen bet yearly wages on single trades. Nobles gambled entire estates. Became tulip casinos. The most valuable, the Switzer pattern bulb, red and white stripes like candy canes, worth a waterfront palace. February 1637, one morning, a tulip auction opened. No one bid. Just like that, the bubble burst. The Tulip Mania bubble. Boom. The aftermath was devastating. Merchants went bankrupt overnight. Families lost generations of wealth. The government had to step in. But here's what most don't know. Only 285 people in Harlem traded tulips out of 42,000 residents, a tiny bubble that changed history. The Dutch learned their lesson. Honor above wealth became their motto. Never seek quick riches. Some lessons take centuries to learn. An honest man always values earning honor over wealth. Today, we call it Tulip Mania. When anything rises far above true value. Bitcoin, Beanie Babies, housing bubbles, all echo Amsterdam's flower fever. The truth is clear. Markets run on stories we tell ourselves until someone asks, why are we paying mansions for flowers? Thanks for reading. And that's where we're going to end it, guys. So that's what we've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. Black Friday coupon code is still active. And we'll catch you guys next time. This is Finding Value.